Interest rates are high. You want to buy a house. How can you save money on your mortgage? Let's talk about it. What's going on, good guys? Chris Newton here, Chris Newton Real Estate, chrisnewtonrealestate.com. Like, comment, subscribe, tell a friend and tell a friend. Take those fingers, hit that subscribe button, and let's go. All right, I went too far. Look, I kind of like it a little dark. All right, cool. All right, so you want to purchase a house. You have money for a down payment. Not only do you have money for a down payment, you have a little extra money on the side. However, these interest rates are killing you. They're out of sixes. They went down, they go up, they went down, they go up. And you just want to buy a house, however, you want to be able to afford the mortgage. What are your options? I'm going to tell you a few options. Well, I'm going to tell you several options, and I'm going to basically break down with you how those options can benefit. So now, a big option that's available, however, not too many people know about. Agents don't say it because a lot of agents don't know, and lenders don't, know as don't tell. Interest is going to be the biggest factor as to why you pay so much money on your mortgage, why you'll also pay thousands, tens of thousands, maybe even hundreds of thousands of dollars in the long run in interest on the property. Interest. So now what do? We attack the interest. How do we get the interest rate down? There's something called a buy down. There are different variations of this buy down. So you'll probably see on Instagram or TikTok where agents like holding up a thing and go, yay, 2-1 buy down. Yes, there's something called a 2-1 buy down. Let's start with, so we have something called a buy down. What's a buy down? A buy down is when you put money specifically towards the interest to buy that interest rate down. So let's talk buyer buy down. A buyer buy down option is when the buyer, the buyer, and or the seller, but this is for the buyers. Buyers will take money that they have, cash that they have, and put that towards the interest rate to buy that interest rate down. How do we do that? So now 1% of the loan amount, 1% of the loan amount equals a point of interest. So to keep it simple, the loan amount is $500,000. 1% of $500,000 is $5,000. So now the buyer can put $5,000 or more towards that interest. So you have your down payment, you have your closing costs. Now I want to put $5,000 of my money straight towards the interest rate to buy that interest rate down. So now let's say, to keep it simple, the interest rate is 7%. A point is basically a quarter of the percent. So $5,000 towards that 7% will now bring that down to 6.75. Okay, just to keep the number simple and a round number, it'll bring it down to 6.75. That may not sound like a lot. That quarter of a percent saves you tens of thousands of dollars in the long run. So yeah, you're coming out your pocket $5,000 then, and it may bring your mortgage down $100 or $200. That's going to help save you money on your mortgage anyway, because let's be real, $5,000, if you have $5,000 to burn, you're going to burn it. Whether you buy in clothes, whether you're buying another car, whether it's gas or something, that money is going to be gone sooner or later, somehow, some way. So why not gone that money with the interest and save you $20,000 in the long run on the course of the interest of the loan. Okay, so now some people will say, why don't I double up? Now I got $10,000. That's going to knock off 2 points. So now 0.5% comes off. So now it goes from 7 to 6.5. That saves you so much money. Now, if you're going to stay there for 3 to 4 years. Does it make sense to do that? No, you're only going to see the rewards in the long run. The long run. You're playing the long game with this, okay? So now year 20, year 25, year 30, you save so much money in interest. So much money in interest. You basically saved another down payment on another house just in interest. And depending on the purchase price of the house, you bought another house in interest and you save that money. So now you also have something called a seller buy down. Same principle. Only difference is, instead of the buyer doing it, you can basically finance that into your loan. So now the seller can pay $5,000 towards your interest rate. Okay, the seller can pay $5,000 towards your interest rate. It's $10,000, whatever the banks will allow, towards your interest rate. That's going to buy down your rate. So now your mortgage payment, your pre-approval can now go up. up to afford it. So let's say your loan amount was only $450 or somewhere it's $475. So you're $25,000 short. Them paying $5,000 towards that helps with your pre-approval to go up. So now you can afford it. You're also saving money in the long run. Okay, so now yes, that $5,000 basically goes into the loan in a sense, but now you're paying interest on $5,000, but it's maybe $11 a month extra. So you're saving so much money because that seller did that. All right, so that's the seller buy down. We spoke about the buyer buy down. Lenders also have a buy down option where the lender will buy down the rate for you. The lender can buy down the rate for you for a short amount of time, maybe the first year, the 2 years, or the 3 years, or not too many lenders do this, but the entirety of the loan. So for the 30 years. For the most part, a lender is going to buy it down for 2 years. So now it's a 2-1 buy down, or they also have a 3-2-1 buy down, where you can do that, but it's more common with the lenders doing. So they'll basically buy down the rate, or they'll bring down the rate 3 point for the second year, 2 point, and for the third year, 1 point. And now that saving rolls into the rest of the loan. So the rest of the 27 years, they'll basically break up that savings that you had and break that into the rest of the 27 years of the loan. And that saves you so much money in the beginning. So now if you was to say, you know what, I'm only going to be in this house for 5 years. That's the plan. And the plan is going to go through. That's a great option for you because you're out of there anyway by the time the rest of that loan kicks in. The rest of that interest loan kicks in. So now we spoke about the 2-1, 3-2-1, buyer buy down, seller buy down, and lender buy down. So those are all options as to how you can save money. But also want to say this, a bigger down payment definitely helps. However, you'll save more money in the interest. You'll save way more money in the interest. I'm going to give you guys one more tip. This is a bonus tip if you guys stay to the end. If you are in a negotiation with a seller, you're in negotiation with a seller, you will save more money having a seller pay $10,000 towards your interest rate than you asking for $10,000 off of the purchase price. I'll say that again. You'll save more money having a seller put $10,000, paying full ask, and asking the seller to put $10,000 towards the interest rate rather than having the seller take $10,000 off of the purchase. $10,000 off of the purchase price along 30 years is nothing. It's nothing. Divide that $10,000 by 30 and then by 12. It's nothing. You will save so much more money doing it towards the interest. Now, I'm only going to give you guys that. You guys want some more sauce? Give me a call. Let's talk. Like, comment, subscribe, tell a friend and tell a friend. That's it. I'll talk to you guys soon. Later.